My sister Kai called me yesterday and she was like, "Hey Alvin, I've been reading a lot about investing. Can you teach me how to buy stocks?" So this video is for my sister and for all of you out there who want to learn more about how to smartly buy individual stocks. So let's dive right into it. I want to share 5 steps on how to go about selecting which stocks that are worth buying. So step number 1, I typically look at industry trends, or you want to buy companies that have favorable trends in the industry it's operating in, and not the opposite. So for example, you don't really want to buy DVD rental companies because nobody rents DVDs anymore, right? Some trends are not that pretty straightforward to figure out. So for example, popular one these days are airline stocks. It's gone significantly since last year. It's probably down by like 60% or something like that. And you might be thinking, oh, maybe it's a great time to buy airline stocks. But the thing is, we don't really know whether there's going to be a permanent change in behavior. So for example, there's going to be a vaccine eventually and people will start to travel again. But for companies, maybe they're going to say that we can conduct business by doing conference calls. Maybe we don't need to pay all these expenses to travel. So that's probably why Berkshire Hathaway, which is Warren Buffett's company, as you already know, I'm a big fan of Warren Buffett. They sold all their stake in the 4 big airline companies in the United States back in April. It's worth a couple of $1 billion. So if you want to buy a company or a stock, ideally it's operating in a favorable industry trend. So one of my favorite trends right now is in artificial intelligence. So when I say artificial intelligence, I'm not talking about robots that are gonna be cooking for us. That might happen, but it's probably like 20 years from now. I'm talking about AI algorithms that companies are using now, today. So for example, banks are using AI algorithms to determine, should I make a loan to this person or not? They're using AI to detect fraud early on. In China, they're using AI in traffic lights, and that's shown to increase traffic flow by around 10-15%. An AI algorithm was developed by Stanford scientists, where this algorithm can read chest x-rays as accurately as human radiologists can. And it does so with less time it takes me to finish the sentence. So if you want to learn more about AI, I strongly recommend reading a book by Kai-Fu Lee and Bernard MARR. Second step that I take in analyzing a stock is I look for companies that have a competitive advantage. Do they have a strong brand? Do they have a loyal following? If they don't have a strong brand, maybe they're the lowest cost producer in the industry. Once a customer has bought their product, is it hard to switch? So for example, a low switching cost example would be buying a face mask. So I actually recently bought a face mask from my friend. It looks really pretty. But if my other friend told me next month that, hey, I have this great face mask that has a really cool design, I might decide to buy from her instead. So low switching cost, right? So an extreme example of a high switching cost is maybe you adopted a dog, you named him Rover, and you see a cuter dog over the weekend when you were walking in a dog park, and you can't go ahead and return Rover, right? That's kind of mean. So you're gonna stick with your dog. So that's like an extreme example. I'm sort of kidding, but that's like an example of a high switching cost. So the third step that I take when analyzing a stock is I look at a couple of financial metrics. So to give us a clue on how good is this company in making money. Buying stocks is essentially buying into a business. So when someone offers you, hey, Alvin, I have a great business idea, I'm going to be like, okay, is this going to make money? You don't want to invest in a business that's going to lose money, right? So one metric that I pay close attention to is called free cash flow. Free cash flow. That means it's the cash that's left over after a company pays for all its operating expenses and capital expenditures. So going back to our face mask example, so let's say you've created a face mask that has this really cool design, it's skyrocketed in Etsy, and you're making $50,000 in revenue. Let's say you have $30,000 in expenses, paying a couple of people to create these masks, and you pay rent and other expenses, materials. And so 50 minus 30, you have $20,000 in profit. That's not free cash flow because, for example, maybe you need to spend $10,000 to buy more sewing machines so you can expand your business. So 20 minus $10,000. The remaining 10K is your free cash flow after you've paid all expenses and capital expenditures. So you want to invest in a company that has consistent free cash flow over the years. The other metric that I pay close attention to is return on investment capital. Return on investment capital. Return on, short for ROIC, it gives us a sense on how well a company is using its money to generate future returns. So you want to buy into a company that is a good steward of its money, right? So there was a study by JP Morgan, and they estimate that the return on investment capital of S&P 500 firms, if you recall, S&P 500 is the 500 large companies in the United States across many different sectors. The ROIC of these S&P 500 firms hover around 9 to 13%. So anything within that range or above that is a pretty good number. The fourth step that I typically take when analyzing a stock is, all right, assuming it looks like this is a good company to invest in, I then ask myself, all right, is it selling at a good price? So if you're out there going shopping for clothes, you're typically looking at a 10% sale, 20, 30%, right? You don't pay for a bag for $700 when it's only worth $500. So it's the same thing with stocks. You don't really want to overpay. And ideally, you want to buy a company at a discount or a fair price. The simplest metric when analyzing whether a stock is selling at a right price or not is called price to earnings ratio. Price to earnings ratio, or PE ratio for short. So let's say you own a sausage tacos food truck. So let's say you had this great recipe that was developed by your Italian grandmother and you've turned it into a food truck business. You're raking in the money, it's selling like hotcakes, you make $10,000 a year and your food truck costs $100,000. If you're making $10,000 using $100,000 in capital, so you're essentially making 10% on your money. So that's a decent return, right? If you compare it with a bank that's only giving you 1% or even less. So price to earnings ratio is you just flip that. So instead of 10,000 divided by 100,000, so you divide 100,000 by 10,000, so you get 10. Your price to earnings ratio of your sausage tacos food truck business is 10. So that's a pretty good number to have. Now, I want to share two caveats though on PE ratios. The first one is not all cheap stocks are great investments. Some call it a value trap, where it looks like it's giving you good value, but it's actually a trap because maybe it's in a declining industry, or maybe there's some kind of accounting scandal that company is involved in. So that's something to keep in mind. Another limitation of PE ratios are it's kind of a poor metric to analyze growth stocks. So what I mean by growth stocks are companies that are growing at a really fast pace, like 20 or 30 or 40% a year. So think Zoom, for example. At the end of 2019, Zoom had 10 million subscribers. And now it's exploded, right? As we all know, they have like more than 300 million subscribers. So that's an example of a growth stock. So P ratios of growth stocks typically are like 30 or 40. In Zoom example, it's like 400 or more. And it's kind of hard to determine whether or not are they expensive. It looks like they all are. I typically look at something similar, and it's called PEG, Pedro, Elephant, Gorilla. So essentially it's the P ratio divided by the growth rate. So if you have a company that has a PE ratio of 20 and it's growing at a pace of 20%, 20 divided by 20, it's 1. So a PEG ratio of 1 or less is a good number to have. I know what you're thinking. You're like, Alvin, I don't have time to compute all of these PE ratios and free cash flow. To be honest, I don't too. So what I do is I subscribe to Morningstar Premium, and they compute all of these ratios for us, right? If you go into a stock, you type in the ticker symbol or the name, it's going to have all the numbers on free cash flow, return on investment capital. They'll even tell you whether the company has a competitive advantage or not. Morningstar will even tell you, okay, is the company selling at a 5% premium or is it selling at a 30% discount? So it's going to have all that information that it's going to make your analysis much easier. So fifth and final step, my friends, is if you're not sure whether it makes sense to buy this stock, then you don't have to buy. It's not like baseball where if you don't swing 3 times, then you're out, right? So Warren Buffett always uses this baseball analogy, and he says that the trick in investing is you don't have to swing at every pitch. You can just sit there and wait pitch after pitch after pitch, and you wait for the right one in your sweet spot, and you swing, and more likely than not, you can make a home run. So that's it, my friends. I hope these 5 steps in analyzing a stock is really helpful for you all. I'm personally interested in hearing how you evaluate the stocks that you decide to buy or not. Please do share them in the comment section below. It's the end of the video, but I do need to say these disclosures. All of these things that I shared should not be construed as investment advice. It's only used for educational and informational purposes. Only past performance is not indicative of future performance. And please do consult with a professional advisor before making any investment decision. Until next time.